I spent a good chunk of the day staring at Bitcoin, reading headlines, scrolling through comments, and trying to figure out why something fell off, not the price, the explanation. Because everybody seems to have settled on the same answer, which is strategy sold 32 Bitcoin. End of story. Mystery solved, right? But the more I sat with that explanation, the less comfortable I became with it. Maybe it's just me. Maybe I'm overthinking it. But if you're holding hundreds of thousands of Bitcoin and you decide to sell, why just sell 32? That's the part I can't get past. 32 Bitcoin is barely a scratch compared to the size of the position. That's why my mind keeps going somewhere else. And before anyone gets upset, let me say this clearly. I have no proof what I'm about to say, right? This is not a fact. This is simply my opinion. Part of me wonders whether the sales itself wasn't the important part. Part of me wonder if the reaction was. Think about what happens afterward. The internet lost its mind. People started debating Michael Saylor. People started questioning strategy. Some investors suddenly acted like Bitcoin's future had changed overnight, all because of 32 Bitcoin. That's what caught my attention. Because if tiny transactions can create that much noise, then maybe what we learned wasn't something about Bitcoin. Maybe we'll learn something about investor. I've always believed that markets are giant emotional machines. People like to think they're making logical decisions, but fear has a funny way of showing up when money is involved. A headline appears. Someone with big names got attached to it. The story spreads. Then people start reacting before they even had times to think. You've probably seen it yourself. Somebody posts breaking news. 10 minutes later, everyone has an opinion. An hour later, people are arguing. By the end of the day, the original stories barely matters anymore because the reactions has become the story. That's what this feels like to me. And honestly, I think Michael Saylor may have accidentally exposed something, or maybe intentionally. I don't know. What I do know is that the market told us something valuable. It's told us there are still a lot of people watching personality more closely than they're watching Bitcoin. That's dangerous because people change, people make decisions, people take profits, people adjust positions, people have reason nobody else knows about. Bitcoin doesn't operate that way. The protocol doesn't wake up one morning and decide it's feeling different. The rules don't suddenly become emotional. Scarcity doesn't take applications. The networks keeps doing exactly what it was designed to do. Yet somehow a small transaction grab more attention than the assets itself. That's fascinating to me. And it leads me to another second thing that caught my eyes this week. Mark Cuban. The reactions to that story fascinated me almost as much as the strategy story. The moments people heard that he sold most of his Bitcoin, some immediately treated it like a warning sign, almost like he was sending everybody a message. But I think people are asking the wrong questions. The question isn't whether Mark Cuban sold. The question is why he didn't sell all of it. Think about that for a second. If somebody completely lose faith in an investment, wouldn't be a logical move to exit the position entirely, 100% out, close the chapter, move on? Yet that's not what happened. He reduced exposure, but he didn't completely walk away. Why? I don't know. And honestly, neither does anybody else outside of Mark Cuban. But it's a question worth talking about. Because there's a big difference between taking some chip off the tables and leaving the casino altogether. Those are two completely different messages. One saying, I'm managing risk. The other say, I no longer believe in this. And from where I'm sitting, those aren't the same thing. That's why I always get nervous when people tries to copy wealthy investor without understanding the reasons behind the move. The public sees the transactions. The billionaires, sees the entire strategies. Those are not the same thing. For all we know, he could be rebalancing. He could be funding another opportunity. He could be managing taxes. He could be increasing liquidity, or maybe he simply felt one asset had more upsides over the next few years. We don't know. What we do know is that he didn't completely shut the door, and that little detail seems to get lost in the conversations. Everybody talk about what he sold. Almost nobody talk about what he kept. And sometimes what some bodies keep telling you just as much as what they let go. That's why I never been comfortable with the ideas of copying wealthy people. Learning from them? Absolutely. Study them? Sure. But treating them like a prophet? That's where trouble starts. Because by the time the public hears about the move is already over. The wealthy don't call everybody beforehand and ask for permission. They act. Then the headlines arrive. Then the analyst begins. Then the debate starts. The public is usually looking in the rear view mirrors while thinking they're looking ahead. That's why I keep coming back to conviction. Real conviction doesn't come from Michael Saylor. Real conviction doesn't come from Mark Cuban. And it certainly shouldn't come from a random guy on YouTube. It comes from understanding what you own. Otherwise, every headline becomes a crisis. Every correction becomes a disaster. Every red candle feels like the end of the world. That sounds exhausting, my friend. Now, while everybody was busy talking about strategies and Mark Cuban, there was another story quietly working its way through the market: Iran. More specifically, several Iranian exchanges that found themselves in the middle of a sanctions discussions. At first, I didn't think much about it. I figured it was another geopolitical headlines. Then I kept reading. Then I started thinking about how people process information. Because when most investors hear words like sanctions, frozen assets, investigations, restrictions, and government actions, they don't usually respond with curiosity. They respond with uncertainty, and uncertainty has a way of spreading. Not because everyone understands the details. Quite often, it's the opposite. People don't know the detail, so they imagine the worst. I watched that happens countless times in markets. The unknown creates a vacuum. The vacuums get filled with speculations. Before long, everyone is reacting to possibility instead of facts. That doesn't mean the concerns aren't real. It simply means emotions often move faster than understanding. And when you combine uncertainty with already nervous market, strange things can happen. One story feeds another. One concern amplifies the next. Before long, you got multiple narratives colliding at the same time. That's why I think the explanations are being pushed around right now is way too simplistic. People want one cause, one villain, one answer. Real markets really work like that. They are messy. Multiple things happens simultaneously. Money moves in different directions. Sentiment shift. Leverage unwinds. Then everybody tries to reduce a complicated situation into a single sentence. That usually where mistake happens. And usually, while I was thinking about all this, another question popped into my head. A lot of people are focused on who sold, but very few people are asking where the money went. Think about that for a second. If investors are selling Bitcoin, those dollars don't simply vanish into thin air. They have to go somewhere, right? Money is always moving from one opportunity to another. So where is it going? The more I looked around, the more one answer kept showing up. AI, Nvidia, semiconductors company, data center, artificial intelligence infrastructure. Right now, Wall Street is treating AI like the hottest table in the casino. Some of the largest pool of capital in the world are pouring money into anything connected to artificial intelligence. And that's got me thinking, how much of the selling pressures we're seeing is actually fair? And how much of it is simply investors chasing what they believe is the faster horse on the track? Because market do this all the time. Capital chases momentums. Capital chases excitement. Capital chases whatever story investors believe can generate the biggest return over the next few quarters. A few years ago, everyone wanted exposure to crypto. Today, everybody wants exposure to AI. Tomorrow, it will probably be something else. That's the nature of markets. In fact, some investors with strong Bitcoin positions may have looked at Nvidia, AI chips makers, and data centers company, and decided they wanted exposures there instead. Not because they suddenly hate Bitcoin, not because Bitcoin's stopped working, not because the long-term thesis disappeared. They may simply believe AI has a chance to move faster right now. Whether they're right or wrong is another conversation entirely. But the possibility makes a lot more sense to me than believing 32 Bitcoins, however, changed the futures of the entire asset. The more I looked at everything together, the more I start asking a different question. Not what causes the decline, what simplified it. That's a complete different conversation, because a market can already be nervous before a headlines arrive. A market can already be vulnerable before somebody sells. A market can already be looking for an excuse before uncertainty showed up. And once the dominoes start falling, people often confused with the trigger underlying weakness. Maybe that's what we're looking at right now. Maybe not. But it makes more sense to me than pretending 32 Bitcoin suddenly changes everything. Because when I zoom out and looked at the bigger pictures, the things that attracted people to Bitcoin haven't disappeared. The supply is still limited. The network is still running. The long-term thesis is still being debated exactly the way it was before all this started. The difference is that sentiment got shaken. And sentiment is the most unstable thing on earth. It can swing from euphoria to panic faster than most people realize. That's why I think the bigger lessons from this week isn't about strategy. It isn't about Mark Cuban. It is even about Iranian exchanges. The lesson is about psychology. It's about how quickly people can become uncertain when influential names enters the conversation. It's about how easily emotions can spread through markets. Most importantly, it's about the dangers of letting someone else's actions determines your entire outlook. Because if a wealthy person's decisions can completely destroy your confidence, then the confidence probably wasn't yours to begin with. And that's something worth thinking about. Maybe I'm wrong. Maybe 6 months from now, I'll look back and laugh at this video. That's possible, but sitting here today, after looking at all these 3 stories and following where some of the money appears to be following, I keep coming back to the same thought. The most revealing things wasn't the 32 Bitcoin. It was how people react to it. And that might have told us more about this market than the transactions itself ever could. All right, my friend, I think this is it for now. I hope to see you in the next video. And my friend, don't forget to hold it tight and stack it right. Take care.